Retail investors are swarming Lupin right now, hooked by a very specific premise: the idea that its recent financial turnaround could multiply their investment, netting them 5 times their money over the next 5 years. But we need to ground those expectations in physical reality. Lupin is a top 10 global generic pharmaceutical manufacturer with over 24,000 employees. Their current footprint is already substantial. They recently crossed 227 billion rupees in annual revenue. That creates a clear mathematical conflict. Can a company with this existing market capitalization actually quintuple its value in half a decade? Or are investors mispricing a mature, heavy industry asset? To find out, we have to strip away the multi-bagger hype and analyze Lupin's structural moat and capital allocation. This chart shows where Lupin's cash is generated. 42. The U.S. section breaks down into complex generics, biosimilars, and injectables, shifting away from plain vanilla pills which suffer from severe price erosion. They are prioritizing high-margin, technologically complex delivery systems, specifically medical inhalers and dry powder devices. That pivot has secured them the number 3 spot in the U.S. generic market by prescription volume, backed by over 600 approved or pending product filings. Meanwhile, that 30% domestic slice provides the stability. In India, Lupin dominates in branded chronic therapies for cardiac and respiratory care. This acts as a reliable, low-risk cash cow. This dual structure, leveraging U.S. complex generics for margin expansion and Indian-branded drugs for baseline stability, creates a deep economic moat. But defending that moat forces them into a constant battle with strict regulatory scrutiny. This dashboard tracks Lupin's profit from deployed capital. It highlights a 30.3% return on capital employed and a 29.1% return on equity. This profile is rare in pharmaceuticals, confirming management extracts significant value compared to the industry average. Over the last few years, the company executed a rigorous cleanup. They cleared out historical U.S. FDA compliance hurdles and paid down their obligations. This waterfall chart reveals the results of that effort. Lupin pushed its net debt-to-equity ratio down to -0.21, building a net cash-positive position of 46.3 billion rupees. However, you have to pay for that quality. Lupin trades at a price-to-earnings ratio of 17.9. While the balance sheet is pristine and insulated against interest rates, that valuation multiple tells us the broader market has already priced in this turnaround. Maintaining that high-margin product lineup requires heavy upfront capital. Lupin dedicates roughly 8 to 9% of its total revenue strictly to research and development. That burn rate compresses their near-term profit margins, but it is an essential expense to fund their biosimilar and novel drug pipeline for the end of the decade. This line chart tracks the payoff of that strategy. Fourth quarter profit after tax grew 33% year-over-year, driving a 62% surge in net income for fiscal year 2026. But before you extrapolate that sharp profit rise, look at management's own forward-looking guidance. The leadership team expects the top line to cross the 100 billion rupee mark in the next 2 to 3 years, forecasting revenue to grow strictly in the high single digits. This is a significant mathematical roadblock for anyone chasing a 5x return. Lupin is successfully compounding cash, but by its own admission, it is not hyperscaling. There is a strategic catalyst on the horizon, an upcoming $3 to $5 billion U.S. patent cliff for small molecules and biologics, opening revenue streams. Lupin is positioning its semaglutide partnerships and complex injectable pipeline to capture that new market share. But every dollar they gain there fights against the gravity of their sector. The U.S. generics market suffers from structural price erosion in the mid-single digits every year. Add to that the constant regulatory risk. A single FDA Form 483 or an import alert at a key facility can halt revenue overnight. It means Lupin is on a product approval treadmill. They have to successfully research, launch, and scale new complex drugs just to offset the decaying prices of older medicines. This shows the cold math of a multi-bagger. To get a 5x return over 5 years requires a compound annual growth rate of roughly 38%. Compare that requirement directly to Lupin's guided 8 to 9% trajectory. The discrepancy is substantial. If you are a hyper-growth chaser whose sole criteria is multiplying your money 5 times, avoid this stock.
The math makes that target unlikely for a company of this size, without an irrational market bubble. However, if you look for quality compounders, Lupin is a buy. You acquire a company with a 30% return on capital and a net cash position, potentially compounding wealth at 12 to 15%. And if you are already holding from a lower cost basis, let it ride. Collect the dividend and let expanding margins work in your favor. Lupin is a successful example of a cash-rich turnaround, but it demands you align your expectations with the reality of large-cap growth, not small-cap fantasy.